Campbell from Stone Castle, and I have our guest Aurora Davidson from Amerigo. And it's very interesting because Amerigo is hitting a brand new high today, which is great to see. And what we'll do is we're just going to run over a number of questions that I have for Aurora, get a better understanding of all about Amerigo and their strategy and background. But before I do, just wanted to remind everyone of the disclaimer. There could perhaps be forward-looking statements in here, both from Stone Castle or from Aurora. This isn't investment advice in any capacity. And then full disclosure, at the time of the recording, which is August 26th, Stone Castle Fund does own shares of Amerigo. So with that being said, let's jump right into it. So Aurora, thanks so much for joining us today. How's your day going?
The day is good. As you mentioned, we are enjoying an all-time high. So it's great timing to be here speaking with you. I appreciate the opportunity to be a guest in your podcast.
Yeah, it sure does. So I was wondering if we can start off, can you give us a bit of a sense of the Amerigo backstory, where Amerigo started, how you guys got into your partnership with Codelco?
Sure, absolutely. Well, the Amerigo story began in 2003 when Amerigo acquired a company in Chile called Minera Valle Central, and its short name MVC. That's our operating asset in Chile. And MVC had a history behind it already. It had been operating as a copper producer by processing the fresh tailings of the El Teniente mine since 1992. So it already had about 11 years of operational history of operations working with the tailings of El Teniente. And Amerigo then came in, bought the asset, and expanded substantially the infrastructure to get us to the production capacity that we have now. So that's essentially how it all started, Bruce.
Okay, that's fantastic. And how has that relationship evolved over the history of the company?
Well, it has evolved because Amerigo has made a substantial amount of investment at the MVC plant to grow it from, we were producing around 20 million pounds of copper per year when it was first acquired, to 60 to 64 million pounds of copper, which is what we produce now. So it has evolved through that commitment, that investment that has been made over the years. We only started working with fresh tailings when MVC was first acquired. We expanded that contract to give us the rights to process also their historic tailings. So it has been a growth story. Sometimes people say, well, Amerigo is not a growth story anymore. It has a long growth record and history behind it, with the objective of getting to this production capacity that we have now.
Okay, fantastic. Now, just switching gears just a little bit, I'd like to get into your backstory and learn a little bit about how you became the CEO and what your background is as well.
Sure. Well, I'm a CPA by training, so my background is in finance. I joined Amerigo not when it had first acquired MVC, but a few months later. So I missed the fun part of the acquisition by a few months. But I've been with Amerigo since 2003. I joined as CFO. I was also working as a fractional CFO at that time. So Amerigo was one of my quote unquote clients, but it was also very close to my heart because of the operational attributes of the MVC story. So I always enjoyed that part of the role very much. With time, I was promoted from CFO to EVP and CFO, and I became CEO in 2019. So it's been a while now, almost a little bit more than 6 years. But my history with Amerigo goes back to 2003.
Okay, well, that's fantastic. Thanks for the background. It's always important for investors to understand, where the CEO comes into play and where they've what their history is and where they came into the company as well. So
Yeah,
one of the things that I know with Amerigo that you talk about is that you're a copper factory and
yeah.
not a miner. Can you elaborate on that? Because I think that's I guess it's your biggest differentiator from a lot of other Canadian companies that are out there trading on the TSX.
Absolutely. And that term, the copper factory, has become very, very useful for us. And we use it a lot. We use it as much as we can because it immediately helps investors understand that Amerigo is not a traditional mining company. When you think about a mine, Bruce, a mine is a geological business first. But if you think about a factory is about process. It's about throughput. It's about efficiency, reliability, margins, which is much closer to what Amerigo is than a mine. So at Amerigo's MVC operation in Chile, what we do is we receive the tailings from a world-class copper system, which is El Teniente mine, and we process that material to recover copper and moly, and then transform that operating activity into cash flow. So that whole genesis of how that all works is very precise, and thus the copper factory tells investors exactly how they should evaluate us. If you think about Amerigo, don't think us only as a copper producer. Evaluate us as a copper processing business that has meaningful leverage to copper prices, that has I would say relatively modest sustaining capital requirements, and also demonstrated returns of capital to shareholders. So that's why the copper factory really is I can't find any other term that describes us better than that.
Well, you don't hear that a lot, the term copper factory, that's for sure. Yeah. So you don't have any of the traditional mining risks that a mining producer would have, but what risks should investors watch out for with Amerigo that could potentially be there?
Well, you mentioned the risks that we don't have are significant to us, and that's also part of differentiating us from the traditional copper producers. When you say which risks we don't have, let me start with those. We don't have exploration risk. We don't have resource replacement risk, and we have lower mining operational risk than most. So that's important to note. But that doesn't mean we're risk-free. Every business has some risks, and if you want to understand Amerigo's risk profile, I think the first and most important risk is our exposure to copper prices. And you may see that as a risk or as a benefit, but it is something that we need to point out. Our business cash flow generation is correlated to the copper price strength. We actually provide investors with very direct copper exposure. So that also means that on the other side of the coin, there's that exposure to copper price. And the second risk is operational execution. Even if our operating profile is simpler than that of a conventional mine, we are still a complex industrial organization. We need to deliver plant reliability. We need to focus all the time on our recoveries, on our production volumes, on cost control. So consistent operational performance, being that that's the engine that converts our copper price into cash flow, is a risk. We have to manage that proactively. A third risk is, by definition, our relationship with Codelco and the long-term availability of tailings from the El Teniente mine. Our business is linked by the hip bone to Codelco's El Teniente mine, so that is an implicit and direct risk that we have to acknowledge. And the fourth source of risk would be let's call it water availability and weather-related impacts. We've seen it at various times in our own operation. We were seeing it in Chile with other mining operations this year. A period of intense rainfall, for example, can have a significant impact on your business. So I would say those are the four major risks that one should acknowledge when investing in Amerigo.
Yeah, can you talk a little bit about that relationship and controlling that risk with Codelco? Do you have agreements in place, and how long would those last for?
Sure. The relationship is essentially a contractual relationship that is governed by a master agreement that the current version was put in place in 2014, and it has a quote-unquote termination date to 2037, which doesn't mean anything. Our initial agreement when Amerigo bought MBC had a termination date of 2021, and we extended it years before to continue working under the same sort of parameters. So what does the agreement give us a right to? It gives us a right to process the tailings from the El Teniente mine, both fresh tailings, which are the tailings that come from the mine, current production, and historic tailings, and to recover copper and molybdenum from those tailings, which we then get to own and sell at market prices. Then we return the tailings to El Teniente. So when people sometimes think about our agreement, they misunderstand that we're buying the tailings from El Teniente, recovering the metal from them, and that we continue to hold on to those tailings. We just basically have the right of way to process those tailings as they pass through our concentrator plant, and then we return those tailings to El Teniente. And what do we give El Teniente in consideration for letting us work with their tailings? We pay them a royalty, and that royalty is based on obviously production levels and the copper and moly prices.
Yeah, one of the questions that I've had asked of me before when I talk about your company is why doesn't the company just process their own tailings? Like why do they have you doing this?
You know, that's a very good question, and that's the first question I asked Klaus Seidler, the founder of Amerigo, when I joined the company. Why doesn't Codelco do this job themselves? And the answer is that both Codelco and Amerigo each bring something different into the partnership. When you think of Codelco as one of the foremost copper companies of the world, their expertise and their capital allocation are focused on what creates the most value for them, which is operating and expanding some of the world's most significant copper mines, including El Teniente. Processing tailings is a different, it's in a different league. It's a smaller business. It's a specialized business. It requires its own infrastructure, its own operating expertise, and its own capital requirements. So we've basically spent decades developing that expertise. But for a company the size of Codelco, with the economic significance of their operations and their capital allocation criteria, working with a small end part of the process, such as tailings, would not make a lot of sense. And they found the perfect solution by finding a partner that could provide the capital, the expertise, and quite importantly, the operational responsibility and execution risk of working with those tailings. So it has worked really well for both parties to the contract.
Yeah, right on. When you talk about being relatively low capex, do you have to spend money on technology to continually improve the recovery of metal out of the tailings?
We have three buckets of capital expenditures. We have sustaining capex. That's basically the amount of money we have to spend each year to continue having a plant in tip-top operating condition. That would basically be the maintenance that you do to your equipment, replacement of critical spares, etc. Another bucket is risk mitigation. We've invested significantly on that as well. Risk mitigation, for example, I'll give you one project that was quite significant to us. We saw years ago that we could have a significant grain event in the region where we operate that could perhaps flood the historic tailing sumps where we're working. So we have a set of kilometers of connecting infrastructure from the sumps to the concentrator plant. So what we did is we invested in wrapping up those pipes with flotation equipment, so that in case of a heavy rain, they wouldn't just sink and be lost. That saved the company in one way. In 2023, when we had a significant amount of flooding in Chile, I think I have a number of videos up there showing how those floaties were basically holding our whole infrastructure above water. And the third bucket of capital expenditure is optimization, and that's what you're referring to. So we invest each year in finding those tweaks and specific improvements, even in segments of the process, that can give us higher recoveries, because we work with huge volumes. So any little increase in recovery, given the amount of volume that we work with, has a significant impact on production. So we invest in that, and it's part of the focus of our team in Chile.
Okay, yeah. So you talked a little bit about looking after and processing the fresh tailings, but you also have the rights to historic. And how much, what's the ratio that you have on an annual basis between fresh and historic? Do you just only deal with the fresh unless you run out, or how does that work?
Our operating philosophy is to process 100% of the fresh tailings of El Teniente. So if you were to ask me what is the first order of business, is to ensure that we can process all of the fresh tailings. And we have capacity at the plant to process more than that, so we top it up with historic tailings. But even if the grade of the historic tailings is higher, it doesn't mean that we would prioritize historic tailings over fresh. Fresh, the opportunity cost of not treating the fresh is that they just pass through and we don't recover any copper from those. Historic tailings are there. We have the rights to them, but if we don't use them today, we'll use them tomorrow. So that's why the operating philosophy is always to focus on the processing of the fresh first.
Do you know if there's a grade difference between the historic and the fresh tailings?
Yes, there is a great difference, and the reason for that is that historic tailings were deposited decades ago by El Teniente, and decades ago, mining was not as efficient as it is now, so there was more copper left behind in the historic tailings than in the fresh. So, for example, 2025, which was is our most recent full annual production data, the grade of the fresh tailings was 0.17% copper, and the grade of the historic tailings for 2025 was 0.24% copper. So there's a difference there.
Yeah, a fairly significant difference for sure. Yeah. And what are your costs roughly to produce a pound?
Well, our significant metric for cost efficiency is the cash cost. And the cash cost in 2025, again, for a full year, was $1.93 per pound. And we also have a normalized cash cost metric of $1.87 per pound. The normalized versus the cash cost measures the impact of our union negotiating agreements in Chile. We pay signing bonuses to our unionized workers for a 3-year term, but we have to expense it all in the month in which we pay the signing bonus. So just to give a normalization of that cash cost, it was $1.87 per pound in 2025.
Yeah, there's always a little bit of accounting in there, right?
There's always something, yeah.
Yeah. So let's switch gears a little bit here and just talk about your capital return strategy, because that's what has so many investors so excited. Can you just talk a little bit about that?
Sure. Our capital return strategy is our Amerigo baby, let's call it that. We call it the CRS because it's just shorter to say CRS than to say capital return strategy. We initiated that in 2021, so time flies. And the reason why we did that was because we had reached a stage in which we had stable operations and we were getting close to repaying the debt that we had taken years ago to expand the infrastructure at MVC without diluting shareholders. So that was also unusual, and but it worked out really well. the fact that we did that expansion 100% through debt. So we were getting to the point where copper prices were stronger, our operation were very, very stable, and the debt was able to be refinanced. And once we did that, we removed the shackles that we had with our bankers, and we were able to start paying out dividends. And so we thought, you know, the traditional mining company does the quarterly dividend or the semi-annual or annual dividend, but that's all they do. And it is a bit of a dangerous game to get into when you're in a cyclical industry like copper is, because you know it better than me. Once you have set up a quarterly dividend, you have to protect it with your life. You cannot reduce it, you cannot suspend it, you cannot eliminate it, because you're going to be penalized by your shareholders for decades. And it had happened to Amerigo before, so we didn't want to go that path again. And we said we have to establish a base dividend that can be sustainable throughout the copper cycle. So that's the quarterly dividend. And the quarterly dividend is the foundation of our capital return strategy. We started with 2 cents Canadian per share per quarter, and now it's at 4 cents Canadian per share per quarter, which is a good dividend in and by itself. But what happens is that we produce a lot more free cash flow than that. So we wanted to have other tools within the capital return strategy arsenal that were flexible and that we could use at a faster rate or a bigger rate, but where we wouldn't have the fixed commitment that is attached to a quarterly dividend. And that's where the performance dividend and the share buybacks come into play. Those are additional distributions. The first point that one has to understand is that we have set up a minimum cash threshold at Amerigo of $30 million US, which we feel is a safe amount of cash to have for working capital and to ensure that we have at least 2 quarterly dividends covered. We have some money to do some buybacks. So above 30 million, we basically distribute everything else to the shareholders. And the mechanisms that allow us to do that quite efficiently are the buybacks and the performance dividends. The performance dividend, we're speaking a lot about it this year because it has gained a significant prominence, given where copper prices are. So if you think about our annualized quarterly dividend, it's 16 cents. So far this year, we have declared 34 cents in performance dividends. So it's more than double the annual dividend just in what has been declared as performance dividends in the first half of the year. So it's pretty significant, but it's a great tool to have because it doesn't force us to make a long-term commitment of increasing the quarterly dividend and then brace ourselves for what could happen should there be a correction in the copper price, which we don't think will happen, but it's still a cyclical.
It still might happen, yeah.
So we want to have that flexibility to have a base commitment with the shareholder, but then also have other tools that are more on and off, more flexible for us to use. And that's where the performance dividend and the share buybacks come into play. And the 3 of them are useful. The 3 of them have a place in the capital return strategy. And I think that what's important for us is for shareholders to understand that either through a quarterly dividend, a performance dividend, or the fact that we're retiring shares from the float, you're getting a comprehensive, well-rounded return on the capital, and that there's a measurable threshold. So 30 million, that's the working capital that Amerigo feels we should retain in the balance sheet. But as soon as we have more than that, we want to be able to return it to the shareholders fast.
So we can watch that cash balance to get an idea of when we're going to get our performance bonus dividends. That's good.
Yeah, absolutely.
How active have you been with your share buyback?
We have been very active with the buybacks. We started with a substantial issuer bid, and we are now into our 5th normal course issuer bid. We like the normal course issuer bid better because it's retiring shares at the market price. So it's just more open and more it's market driven. We have retired 15% of our shares since we started the CRS. So we've been very active every year.
Yeah, okay, that's great. And what level of ownership does management and insiders have?
We have 13%, 13%.
13. Okay, yeah, that's fantastic. Yeah. And then can you talk a little bit about how you manage copper prices? Do you hedge or are you unhedged? How does that work?
We don't hedge. We've had very little history with hedging, mostly attached to debt commitments in the past. But there's a reason for why we don't hedge. We believe that our shareholders are with us to have that exposure to copper price, and hedging is a way of protecting or constraining that upside. We understand this, and we've learned it since the beginning. The people that are with Amerigo want that exposure to copper prices, so we want to give it to them. So we don't hedge, but what we do, and on the other side of the coin, is that we manage very carefully everything else that is within our control. We focus on maintaining a low-cost operation, maximizing our recoveries, controlling our costs, protecting the balance sheet. So that gives us the resilience across commodity price cycles, which is something that we have to do if you're exposed on the commodity price side of things. And if you think about it, Bruce, even our capital return strategy has been designed with copper price volatility in mind. We just spoke about the quarterly dividends, the sustained performance dividends. So maintaining a sustainable quarterly dividend that can be supported through the cycle and then is just supplemented with performance dividends and buybacks is a response to why to the fact that we don't hedge. And we feel better doing it this way and maintaining the other levers of the company well balanced to ensure that we can not hedge and still sleep well at night.
Yeah. Okay, that's great. So what catalysts would you say that investors should watch for over the next 12, 24 months with Amerigo?
12 to 24 months. Well, I think there are 3 catalysts that I would highlight. The first, of course, is copper price. We've spoken about that. Given that we have that direct exposure to copper price, that is the most significant driver of value. That's the copper price itself. If investors continue watching the balance that exists between a growing demand and the industry's challenges in supplying that copper, they can see that the fundamentals for copper price are strong, and we believe that is the case. The second catalyst is operational execution, and I know that sounds very boring, but it's very true. Our model is designed for consistency rather than for dramatic production swings. So investors watching Amerigo should continue to watch our ability to deliver stable production and to control our costs. And the third catalyst are the capital returns that we were speaking about. Amerigo is differentiated because we convert cash flow into shareholder returns. So if investors are watching copper prices, they're watching operating performance, then they can see as well how that cash generation will continue translating into shareholder returns through the mechanisms of the capital return strategy.
Yeah, okay, that's great. When you go out on the road and speak to investors, what would you say is the thing that's most misunderstood about Amerigo that you always like to clarify?
Well, I think that it's mostly a question of completeness of the story more than anything else. Investors get us, get that we are a copper producer, but sometimes they stop there, and our work and part of the story that we have to continue to emphasize is that don't look at us just as a copper producer, because in doing so, you're going to be missing some special attributes. First, the fact that Amerigo combines copper exposure with lower operating risk, with lower capital intensity, and with a very disciplined approach to capital allocation. So that's very important for us to continue conveying to investors. Also, very important is to continue telling the story about how we are returning the capital to shareholders. And one of the themes that we're working a lot in recent months is the theme of total yield, not just the dividend yield. Because if you just look at the 16 cents that we pay as a quarterly dividend over our share price to get a yield, it's not that interesting. But if you start adding up the quarterly dividend and the performance dividend, then you get a different metric altogether. You get right now this year more than 3 times higher total yield compared to the stated yield. So we're trying to convey that and to educate people that, you know, the performance dividend is not just a fluke that happens because of good luck from one quarter and we're not going to do it again. And that's why we didn't call it a special dividend, because a special dividend, the connotation is that it's too special. I mean, it's like a little gift, Christmas, the thing here. This is based on the foundational aspect of a company. We generate free cash flow, and we have a mechanism that returns it responsibly to shareholders. So it's very important for us to continue conveying that. And it's a different story, and it's a different attribute than most other companies have, mining companies or not mining companies. So that's why we have to continue working with that.
Yeah, okay, that's great. Well, let's switch gears here just at the end and bring in a little bit of fun. So you're about to go on stage speaking at a mining conference or maybe a production conference. What would be your walkout song?
It would be the theme from Law and Order.
Oh, okay. How come?
You know the theme. You just play it on the back of your hand. Well, I think it's befitting to Amerigo. It's we've been around for decades. We're a flashy company. It's a story about a well laid out plan with reliable characters that come in and, you know, deliver the work without too much drama and without too much flashiness. So I think we're very similar in that way. So I would use that one.
Okay, well, that's a great one. I haven't heard that one before, so love that one. So let's do a couple of rapid fire questions here just to get a sense of who Aurora is. So coffee or tea?
Coffee.
Burgers or sushi?
Burgers.
Are you an early bird or a night owl?
I'm an early bird.
Okay, yeah. Books or podcasts?
It would have been books for many, many years, but now it's podcasts.
Okay, yeah. iPhone or Android?
iPhone.
And let's finish this one. Cats or dogs?
Dogs. I don't even know what cats
are. There you go. Well, thank you so much for your time, Aurora. It's been fantastic. We really do appreciate it. Everyone that was tuning in was very attentive from what I can see. And I mean, the story just keeps on going, right? With your performance dividends that you paid this year, plus the other, the regular dividend and the share buybacks, you can see why the stock's hitting highs for sure. So thank you so much for your time today. That was fantastic.
Thank you so much. I really appreciate it.
Yeah, take care, everyone.